On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. Morning team, hope you're all well. Feels like I haven't talked to you for ages. It's been a whole week since I recorded something. I usually do 2 episodes a week, but I skipped the one on Sunday, so it's been a whole week. And for everyone who has asked, no, I did not spend the weekend going to Vegas to watch the Warriors, thankfully. That was an awful game. Don't want to see that again. The family and I actually went over to Melbourne to catch Green Day on tour because they didn't do a New Zealand show, so we had to go over there. Epic concert, had a blast. My 10-year-old boy loves Green Day, as do I. So we all had fun. The 6-year-old struggled a little bit, pretty tough, especially with the time difference. So 6, that's a good introduction to the world of rock music, but he did do it tough. So well done him. He's off the donut, and hopefully he'll know what he is in for when we go to our next family concert, which I think is Metallica in November. Anyway, what are we here to talk about today? Well, I thought I would cover something that you often see when you're in a down market, which is an article about how you'd be much worse off if you'd missed the 10 best days in any given period. We usually see those during rough patches, and they usually come out in the hope that it'll calm investors down and ensure they stay the course, rather than panicking and selling at what is often precisely the wrong time. So at some point over my 2 decades in the industry, I've probably written about this myself. The numbers are always compelling, talking about missing those 10 best days. Now, if you'd invested 10 grand in the S&P 500 index in the US 30 years ago and left it alone, you'd have over $230,000 today. So that's a big increase. However, if you had missed the 10 strongest days, just the 10 strongest trading days out of those 30 years, you'd only have $113,000. Now that's still 11 times more than you started with 10 grand, remember, but it's 51% less than if you had simply stayed put. So missing those 10 best days meant that you only had half the money that you could have had. Now that's a really admirable message, and it is always very good advice to keep your eye on the long game rather than tinkering too much along the way. However, a point that is often missed is that the 10 best days usually come during the roughest periods, and that means they come in very close proximity to the 10 worst days. Let's look back over those 3 decades that we've used as an example. Now, the 10 best days all came either during the GFC, the global financial crisis, in 2008 or 2009, or in early 2020, when you had those harsh lockdowns during the COVID period that shuttered the global economy. So 7 of those 10 best days came within just a week of one of the top 10 worst days. See my point? They go hand in hand. And if your crystal ball is that good anyway, and it allows you to choose between one or the other, you'd actually much better off avoiding the worst 10. That would mean your 10 grand has grown to nearly $550,000 over those 30 years. That's more than double that of the buy and hold investor. However, that's highly unrealistic too, because the strongest and the weakest days tend to come during the most volatile periods, so they do go hand in hand. And if you really did miss those 10 best days, the truth is you're probably no worse off, as you would have almost certainly missed some of the worst 10 as well. In that previous example, missing both the worst 10 and the best 10 would have seen our $10,000 increase to $263,000 today. Now that's higher than the stay the course outcome, but not dramatically so. Market corrections, which we generally think of as declines of 10% or more from a peak, they're normal. If you look back to 1960, the S&P 500 index in the US has experienced 33 corrections. So they come every 2 years or so, on average. Now, 10 of those 33 evolved into more painful bear markets, where the index fell more than 20% or more, and the other 23 led to an average decline from the peak of just below 15%, and they lasted an average of 4 months before the recovery took hold. The most recent correction came in the second half of 2023, when the market fell 10.3% before bouncing again. Now, I don't know when the next correction will come, but I'm sure it won't be too long before we see another one, especially after the great run that we've seen from US equities these last 2 years. Right now, today, the S&P 500 has slipped a little more than 5% from its record high from last month, February, and that's come on the back of concerns over tariffs, among other things. Now, that volatility might blow over quickly, or we could see further weakness before markets stabilise. And if that happens, there's a good chance you'll see an article warning you about what will happen if you miss the 10 best days. Now, despite that erroneous thinking, for the reasons I've mentioned, I think you should still take note of the sentiment. The author isn't trying to swindle you. They're just trying to politely remind you that timing the market is extremely difficult and that you're often better to sit tight and stay put. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.